Hi, today we're learning about indexes, market cap, and market orders. So there are two types of stock out there. There are income stocks and there are growth stocks. So income stocks are stocks that pay dividends. And a dividend is a payment that usually happens each quarter, which is 4 times a year. And dividends are given to a shareholder, and they come from the profits of a company. So to give you an example of an income stock, let me go to Google Finance here, and let's go to GE. So here is GE's stock, and if I do a year to date, this is from the beginning of 2009. You can see that here on February 19th, GE released a dividend of 31 cents per share. Here on, what was this, June 18th, 2009, GE released a dividend of 10 cents per share, and we had a dividend of 10 cents per share here on September the 17th. Probably in November they'll release another dividend. So what these dividends mean is that if you own one share of stock in GE, you will be given 31 cents per share. So what a lot of wealthy people do is they will invest in a company like GE, and they will just live off of the income that they get from the dividends. So if we open up the calculator here, let's assume that I own 1,000,000 shares of GE. So I'm going to type in 1,000,000 here. Okay, so that's 1,000,000. And if I get 31 cents for every single share, so times 0.31, that equals $310,000. So that is income. That's income that a person has coming to them, and they can go to McDonald's and buy a bunch of hamburgers if they want. They can go to Target and they can reinvest that money into GE stock or any stock that they want to. But this is income for that person. So if they receive a dividend of 31 cents right here, and if they own 1,000,000 shares, they'll get $310,000. Now, let's say June comes along, and if they've got 1,000,000 shares, and if the dividend right here is 10 cents, then we just multiply that million times 10 cents, and that equals $100,000. So right there, the person has already made $410,000 for the year, and that's just income coming into them. So that's an example of an income stock. The people that usually buy these income stocks, they don't care about the price, whatever GE is trading it at the moment, because they know they're going to get this dividend, and that's where their income is coming from. Hopefully, yeah, that stock price will go up, but the main reason that they invest in a stock like this is to receive those dividends per share. So that's an example of an income stock. Now, a growth stock, these are stocks that don't pay dividends. The company just reinvests the profits back into the company so that the stock goes up in value. And an example of this, of course, would be Google. If we look at Google since it went public, so you'll notice back here when the stock went public, it was trading at around, I don't know, $100, and then in 2007, the stock was all the way up to about $700. So if I bring this back right here, so notice right here on, what was it, October 5th, 2007, Google was trading at $594, and the opening price was somewhere around $108. Well, my rate of return would have been 488%. So not too bad. But Google's a prime example of a growth stock where the company just takes its profits and it reinvests those profits into the company instead of giving its shareholders a dividend. All right, next thing we're going to talk about is other terms you might need to know. For example, blue chip stocks. And these are companies that are well established. These are companies like Shell, Coke, IBM, and usually these blue chip stocks, they're stocks that have done well over time, and the price of these shares, they're pretty expensive, but the companies are going to continue to do well. Penny stocks, these are stocks that sell for less than $5. An example would be Solar Enertech Corp. If we look at this on Google Finance, we can see that this company right here is trading at about 26 cents per share. So this would be an example of a penny stock because the stock is literally worth pennies. One share of stock is worth pennies. All right. So let's talk about stock market indexes. Index is nothing more than an average. It's actually a weighted average, which is the same as an average, but it's a little bit different the way that you calculate the average. You just take a number of stocks and you find this weighted average, and it gives you a pretty good statistic of how the stock market doing, or how a certain sector of the stock market is doing. So yeah, so stock market index is used for tracking the overall progress of a certain market or industry. So the big indexes that most people follow are, there are two for the New York Stock Exchange. One's for the Dow Jones Industrial Average, and this Dow Jones Industrial Average tracks 30 of the best blue chip stocks out there. Then you've got the S&P 500, which is the weighted average of 500 blue chip stocks. You also have the NASDAQ, which is a composite of all the stocks that are trading on the NASDAQ. So if we go to Google Finance, if I just go to the home page, you'll see that the first thing that shows up is these averages. So here's the Dow. Looks like the Dow is at 10,219 points, and it's gone up 195 points from yesterday. Here's the S&P, it's also gone up, and you got the NASDAQ. So the Dow, S&P, and NASDAQ, these are indexes. They're not stocks that you can actually buy and trade. They're more or less, it's just a simple statistic, kind of like a statistic for, for a sport. You might have a statistic that tells you how your team is doing. Well, this is kind of like the same thing. This is a statistic. It's an average that's showing you how the stock market is doing in general. And most people follow the Dow Jones. All right, so let's talk about market capitalization, also known as market cap. And this is what the public agrees that a company is worth. So to find it, you take the number of shares and you multiply that by the price that the stock is currently trading at. So for example, if Coke has 2.3 billion shares out there, and each one of those shares is trading at $60 per share, then Coke is worth $138 billion. So let's actually go to Boeing, BA for Boeing. So Boeing is currently trading at $51.28, and there are 726.6 million shares out there. So 726.6 million times 51.28 is 37.26 billion. So this is the market cap of Boeing. This is what Boeing is pretty much worth. All of its stock is worth. So which is worth more, Microsoft or Google? Well, you can find out by going to, let's look at Microsoft's, MSFT, there we are. So Microsoft's market cap is currently 257 billion, and Google's market cap is 177.97 billion. So Microsoft currently has a higher market cap than Google. All right, last thing that we're going to look at, we're just going to talk about a market order. This is an order. Whenever you want to buy stock, you place an order, and a market order is an order to buy or sell stock at the current trading price. So if I placed an order to buy Google right now, at a market order, my market order would be to buy stock at $561. So that's what it's currently trading at. Normally when you buy stock with a broker, you have to pay commission on an order, and it doesn't matter if your order is 1 stock or 1,000 shares of stock. If you buy 1 share or 1,000 shares, that's 1 order, and that order is usually going to cost you a commission of $10. So when you buy a stock, you usually have to give it the following information. You want to tell it what type of order. Are you buying or selling? Well, if you're buying, it's got to be a buy order. You give it the number of shares that you want to buy of your stock. You give it the term. Is it day or like good till canceled? Most people just do what you call day orders. And pricing type. Is it a market order or a limit order or a sold order? For the time being, just understand that a market order is in order to buy stock at the price that the stock is currently trading at. So that's it for today. Thanks for tuning in, and we'll catch you later.